even close tomorrow, but we will take the opportunity to review, as always, the week past, and we're joined by our regular Sunday commentators, Mike Muller, head of Vitol Asia, and Christoph Ruhl, senior research scholar, Center on Global Energy Policy, Columbia University. Let's kick off with Christoph. Christoph, was OPEC's decision on Thursday, you think, a vote of confidence in demand recovery, or looking over their shoulder at shale sharpening their knives, ready to come back into the market? How do you interpret last week's decision?
Good morning and happy Easter, actually, to everyone, even those who don't celebrate. Happy
Absolutely.
Easter. It's always good to celebrate.
It's also the Jewish holiday of Passover, the last day of Passover.
Happy that one as well.
Yes.
For celebrations. I think little bit of both. I think by and large, you have to, I mean, first of all, the autopsy thing, I was serious. We should not perform autopsies because OPEC is far from dead. I think by and large, they have done a very good job, including this latest move, well orchestrated, well sort of pre-announced. And the situation we are in, actually, when you look back, pretty much reflects the path of the pandemic and of the economy and therefore of oil demand. Remember when they started out in April 20, then the last published target would have been January 2021. And what they said at the time was that by that time, the cuts should be about 5.8 million barrels per day. Now we know in January it was above 7. Until last week, it was above 7 million barrels per day. With this petering of the pre-announced cuts, we will come down to this target of 5.8 or 5.75 to be precise, if my numbers are correct, by July. So that means we are on course with a 7-month delay and with the additional flexibility of the Saudi 1 million, which they can use as a safety valve going up and down. And that, to me, represents a pretty close tracking of what has happened when you think of the original estimates, how long the pandemic would take, when the vaccine would come, how the V-shaped recovery, the famous one, would patter out. That all took a little bit longer, and the 7 months delay seemed to be pretty much in tune with actual developments. And as you can tell by the oil price, so the intent clearly is to leave it above 60. The fear clearly, as you said, is that above 65 or so the knives would come out of shale and other private producers. So there, the final end game is still uncertain, but the corridor until the cuts are sort of back to a normal excess capacity of 2.5 million, that path becomes pretty clear, just as the recovery path from the pandemic now has become clear. It's a simple story. When you have the vaccine, the pandemic will recede into the background of the day-to-day talks. If you don't, you continue your darkness and lockouts and so on.
Let's bring in Mike Muller. Welcome back, Mike, to the table. Mike, this is the third meeting in a row when most market watchers and actors have sort of predicted the wrong outcome of the OPEC decision. I'm wondering, what does that tell us? What does it tell you about where the market's at? And what impact does it have when so many people are reading the market or making calls that are not correct?
Thank you, Sean. I think you summed it up very nicely in a tweet midweek when you predicted that maybe the surprise would be no surprise. It's very helpful that you put the numbers up for everyone's benefit, actually. So on the screen you're sharing there, you're seeing a total, including the winding back gradually of the Saudi voluntary 1 million per day cut, a total over 3 months of 2.15 million. But of course, divide that by 3, please, to get about 700,000 barrels a day. That's the actual average over 3 months. And of course, that amounts to something in the order of 600 and something like 60 million barrels over 90-day period or a 92-day period that we're looking at here. So was it a surprise? Well, let's just look at what the market did. I mean, last time around, the OPEC meeting resulted in a price move up towards or even slightly above $70 a barrel. And then we got increasing bad news. And as Crown Prince Abdulaziz bin Salman said, they were kind of vindicated, even though he was very modest about it. With hindsight, whether it was foresight or not, more bad news happened on the pandemic front than was perhaps anticipated a month ago. This time round, the smart money seemed to be predicting, and I stress seemed to be predicting that there would be no change and a rollover in all the numbers, including the Saudi voluntary 1 million per day cut. And of course, the smart money also knows that that's not necessary under just about any scenario other than a new strain that evades the vaccines. So it is very clear, and we have very many signals in the market, which I'm sure Christoph will pile in and add to as well, that economic recovery and therefore oil demand growth is something that we will see. In terms of how markets trade, we have the markets now trading beyond the refinery turnaround season, so demand for crude is better, and you're seeing that manifesting itself in various things. But we'll come on to the supply demand later. Did they surprise the market? I think a lot of people subconsciously felt, look, they rolled it last time round. They're doing monthly revisions anyway, so each decision is a spot month-by-month decision, and therefore there is a little they can give. And the market bore that out because, as you saw, Thursday's price action was quite remarkable. It opened at 62.30 and it finished more than $2.50 stronger than that, more or less unchanged on the week. And that's telling you, I think, that the market feels that world supply can be increased somewhat because demand growth has the capacity to absorb it over the Q2 period into July. So it's not a huge price response to the news, and OPEC seemed to have tuned it roughly in line with expectations, even though everyone was talking the market up. And why was everyone talking? Well, why was everyone expecting there to be no change in OPEC supply? Possibly because so many people are long and wishing it up.
Right. So everybody's talking their own book, so to speak. Christoph, the other two stories we have in the Digest Week in Review is, which I'm wondering your views on how they play into the thinking maybe of OPEC Plus. The US oil rig count, again, posting a double-digit gain on the week, the Baker Hughes numbers. And then on the flip side, India, who got very cross after the last decision, are actually taking action to sort of diversify their supply of crude oil away from the OPEC Plus countries. Your thoughts of those two things and how they might be impacting the decisions that OPEC Plus are making, or indeed how they're impacting the market?
Yeah, on the first one, I first of all, rare but increasingly common. I agree with Mike completely. I think the market's expecting no cuts at all. That was a bit book talking. What you actually see in this very modest positive reaction is the markets were glad not to be surprised. And I think they feel quite comfortable in that. I think it's really clear now. We have the 60 to 65 sort of target corridor until inventories and spare capacity, very important in the future, in OPEC Plus has normalized. And then is the big open question, and that's where your thing comes in. 60 to 65 is already a comfort range by which shale and others will come back. And that's why I keep on saying that the end game is not clear, because it's a bit of a race now with demand strong and economic recovery strong. We may actually get to further cuts in that corridor or not far away from it. But at the end of the day, that will continue an increase in production in the US. That means that the US has good chances not to lose its status as a net oil exporter. And as that becomes an issue again, we'll continue to become more supportive to the fossil industry, first signs of which we have seen in the statements of the energy minister prior to the OPEC meeting. And it's going to be, it's a miracle to me, it's a question to me, how OPEC Plus will get out of this corridor once inventories and spare capacity are back to normal, other than by hoping that then demand growth and economic growth will just be strong enough, like in the old days, of accommodating and increasing production from the US and from other parts of the world. That's one. The other one on India, I think, is a bit of an overblown story. First of all, India hasn't turned away from OPEC Plus, but only from the Middle Eastern OPEC producers, and maybe not even turned away, but threatened to do it, was my understanding. Secondly, can't emphasize it often enough, it's a global market. So under the surface, there can be all sorts of movements in India and China. Both have made these moves of saying, oh, we buy our oil somewhere else. But it's an adjustment cost. It's a transaction cost, not a fundamental change, because that just means that oil comes from somewhere else, and from a producer point of view goes somewhere else. It really is a global pot in which the oil is pumped and which it is taken out from. And people like Mike will like these moves under the surface, because they, these adjustments generate income possibilities for traders and for those who produce and adjust the oil flows. But for a market observer from the outside, they don't cause a big glucose or an increase in prices all by themselves. And India is sort of, in particular, this minister is famous for playing the national card and has done this very often, not very often with consequence so far. So on that one, I would be quite relaxed.
Mike, we've had a lot of focus in recent times, and again on the Week in Review Digest, we've included it. US demand recovery, employment is looking stronger, flights, aviation fuel demand. But China's gone a little bit silent on the demand side. I'm wondering, what are your thoughts there? The China outlook, we're now trading May, June contracts.
Yes, I think, again, that needs putting in context. China is not celebrating Easter week, but the weekend right now is their famous tomb sweeping weekend. And it is also one of the lesser grand migration events. And I saw an update just a few hours ago that it is expected that 100 million people will travel outside of their home city this weekend. And the rail statistics suggest that 50 million of those are railway tickets. So that's getting on for a small version of Chinese New Year. And of course, with so many people having been instructed to give the Chinese New Year family visits a miss, and with large parts of China being and behaving virus-free, it's an understandable catch-up reaction. And it's that same pent-up demand we keep talking about in the entire global economy, where people who have the ability to save money, who have not spent money on entertaining, going out, eating out, and traveling, have a strong desire to catch up and do so. Furthermore, as I mentioned before, refinery maintenance season is over, and China has been busily responding to the higher prices, as they always do, by drawing inventories rather than importing more oil. And that draw, I will predict, is going to be seen in the coming weeks and months. And therefore, I do expect Chinese buying to get back not just to normal, but as many are observing, to keep growing, because, of course, the new constructed Chinese refining system, highly integrated with petrochemicals for the most part, has a resilience for many reasons, including domestic pricing, and therefore they will continue to take market share away from other Asian refiners. And that's going to keep that sucking noise going, and it's going to be a crescendo in my view. So I guess
what's the consequence of that as China refinery? I mean, they're forecast to grow to the largest in the world this year. What is the consequence for the other Asian refiners, including India, as China bulks up and becomes a more significant exporter of products across Asia?
No, very good question. I mean, the consequences have already been seen, because there have been refinery closures and announcements of scale backs in capacity. Shell in the Philippines and in Singapore, 2 Australian refiners have fallen by the wayside in the last 4 or 5 months. So those are your casualties. Margins have held up reasonably okay. You mentioned India. India is a little more resilient. It has some of the world's most complex refineries, not just in the private sector with Reliance and Nayara, but also in the PSU sector. And just to follow up on your question on India from before very quickly, I mean, many Indian refineries have a term negotiation cycle that runs from April through March. So it's quite normal for there to be a little bit more rhetoric in the first quarter of the year as they poise themselves for those negotiations. But the other point in India is that they have historically had a much higher proportion of their crude oil tied up in term purchases of non-tradable Middle Eastern oil. And this gives them reduced agility and flexibility in a world where your marginal barrel in the East is being set by Atlantic Basin arbitrage barrels. And you've got the advent of the IFAD exchange, which we may talk about a little later.
Christoph, you wanted to jump in there?
Yeah, there's something wrong with Mike's numbers, I'm afraid. If 50 million Chinese buy a train ticket, and if China has 1.6 billion people, that's about 0.3%. That will not change the dial on refining demand.
But on the 100 million as a whole, I suppose, traveling in the
that's
day.
That's 0.6 million percent. 0.6%, Sean. Less than average Saturday.
Well, it all helps, I suppose, on the margins. But Christoph, looking at the US news last week, the big sort of headline of the next stimulus package, infrastructure, another sort of multiple $trillion stimulus of some sorts. Your thoughts on that from the immediate impact as well as the midterm impact?
This is a package which is large, but not that large when you think it's stretched out supposedly over 10 years. So that brings it down to about 200 something, around 250 billion, say, per year. Number one. Number two, it's unlikely that it passes Congress. The Republicans have already promised to fight it tooth and nails for very selfish reasons. Having said that, it's bitterly necessary. The infrastructure, in the US has not kept pace, as everybody who goes there will testify, with the private sector developments over time, and is in need of upgrading and of repair. And as others have said before, of course, this is fundamentally different from the current stimulus, because these are not transfer payments for people who can spend the money on consumer goods which are produced in probably increasingly tight production conditions and therefore inflationary. These infrastructure investments, if they come gradually enough to allow for the appropriate buildup, will expand the productive capacity of the economy. So in the language of economists, the output gap, the difference between what is produced and what can be produced, will be made wider by these infrastructure investments, and that relieves the kind of economic pressure that you get if the gap becomes very small and production increases go into prices. Let me steer the direction in something else, which I think happened last week. Next week, we're going to have the World Bank IMF meetings, and they will focus very much on global growth. And also what will come to the fore is this question that global growth will be very uneven between the haves and have-nots. And last week, we had a taste of what this could imply, because when I thought about this meeting today, what happened last week, one of the things other than OPEC which came to my mind is the increase in tensions, bilateral and multilateral tensions in the world. Myanmar with this very nasty coup, which backed by China. Ukraine with the threat of common NATO maneuvers and threats by Russia. And then, of course, the attempt, so that's the Russia-China-US angle. And that's then the attempt of sitting down with Iran, which probably is on your list of questions still. So that's something I wanted to flag, which we should in the future probably have to spend some time on, how this uneven performance and the Biden administration at the same time translate into an increase in tensions in the world.
Mike, just picking up on that point on the Iran question, obviously OPEC Plus are trying to navigate demand recovery while also dealing with an unknown amount of barrels that could be coming out of Iran into China. There's some reports that the Iranian barrels are even sort of clogging up the ports in China. There's so much of it. What's the outlook for that? And then we have this coming week, the beginning of what seems like an indirect sit down between the US and Iran and the other members of the Iran nuclear agreement.
Yes, indeed. On that last point, there's talk of an indirect, in other words, brokered or mediated session, which some years back was the role of the Swiss. As for cargoes of Iranian material piling up outside China, I think that's a little overstating things. There was an interesting comment made by one of the Iran experts in our field, Faradun Fisharaki, at his Fushkon conference last week, that the Iranians were claiming they'd sold out of all products they can export, which is the sort of bravado statement you get sometimes, but it's not really anything new. The big question I'll answer your question with is whether the Biden administration has quite the same fervor over intervening as perhaps the Trump administration was perceived to be, because they didn't intervene all that much either. And it is a fact, and a widely known fact, that substantial amounts of Iranian products are moving into the market and finding their way into pricing centers such as Singapore and China.
And just to follow up on that, Mike, from the point of view of the launch this week of the new IFAD and Murban contract pricing, the sweeter barrels of Murban, how did that go? Is it a big change? Is it too early to tell? Generally, what's the first week prognostics?
Well, there are plenty of people who are commenting that the volumes look a little light. And of course, the immediate comparison will be drawn to the other Middle Eastern exchange, the DME. We mustn't forget, of course, DME is long established and has Saudi Asian crude pricing off at 50%. The startup was encouraging in terms of open interest, in terms of volume in the back months, and in terms of the role performed by market makers. So unsurprisingly, as most exchanges do when they want something to be a success, they appoint professional market making companies who make a very tight market. And of course, for IFAD, which is ICE Futures Abu Dhabi, it sits on the same platform as ICE Brent. And it therefore follows that it's quite easy to interpolate and to make very tight markets. And I noticed that for most of the day, there's a 3 or 4 cent tight bid-offer spread. And with reasonable volume either side. So if somebody wants to be a price taker, the volume is there. And of course, the main interaction that the Asian refining market is after is to make a link between Murban and Dubai. And the main one that the traders are interested in, of course, is Murban Brent and Murban WTI, where you will see people likely doing what they've already done before IFAD started, which is evaluating the economics of buying something like a Midland or a CPC blend from the Caspian and comparing that in value to Murban. And now, of course, you can do it on an exchange. And the big development with Murban is that in the past, physical Murban might, in a market that changes direction, might trade out over 2 days, and then there's no Murban market anymore. Now you can trade it every single day of the month, and that's a pretty encouraging feature. And of course, with the underpinning that all crudes from Abu Dhabi, not just Murban, all crudes from Abu Dhabi, at current quota 2.6, 2.7 million barrels a day of oil is freely tradable. So it's an encouraging start, because there's a trade every 5 or 6 minutes. I mean, even when things are quiet. And our traders got up at 6 o'clock in the morning on the Monday last week, 6 days ago. And yes, there were bids and offers, and there was action. So it's good.
And across the curve apparently as well out to December. Christoph, the big sort of data point that's also being watched by the markets is the vaccination rollout. And certainly the headlines out of the US are rather impressive. What was 100 million vaccine targets in the first 100 days of Biden has now been increased to a massive 200 million, which of course is only a few days away. The 20th of April would be the 100 days or something like that, the end of April. So they're making major strides there. Europe, not so much. I mean, what's the outlook, do you think, of, as you mentioned, inconsistent, uneven recovery from the pandemic? The underpinning of that is the vaccine rollout.
Yes, that's right, unfortunately. And what we see is, sort of unsurprisingly, a bit of an uneven rollout there as well. Let's just be clear about the starting point again. I think everybody should realize now that we know how to deal with COVID and how the game will end. And this is by vaccinating people. Pending a big super bug, that brings down fatality rates, hospitalization rates, and even infection rates, so that it will become like normal as the flu, will be with us for the rest of our lives, but will not, have these crazy situations. Now, what we see in the world is there are some regions where the vaccination, I would argue, is beyond a tipping point in a positive sense. You mentioned the US, perhaps the UK, for sure China, Russia, and some of the affiliated countries like Kazakhstan. Smaller places like Chile, some people say Serbia, Israel, the UAE. So these are moving in the right direction, full steam. There are laggards which are now catching up, and the biggest of them is the European Union. But even in the European Union now, Germany has 11% vaccination rates. France is sort of pushed into another lockdown because there the problem is more to persuade people to take the vaccine, and that's a matter of time in my mind. So even dark Europe will, by the summer, get on the other side of that hump. And then there are the biggest losers, which are the countries which can't afford the vaccine. Almost all of Africa, large parts of Southeast Asia. The hope is that the rich part of the world will have enough sense to enable the poor part to get vaccinated, because otherwise it will backfire to them. They can't keep borders closed, and not even to the deep south, to the poorer countries. So I think that I'm quite optimistic that if there's no super bug, that by the end of that summer, we are really seeing the end of the tunnel, not just some erratic lights, but the end of the tunnel. Then the whole game in the world will be back to normal. The big recovery, sort of 1 year growth spurt, will be over, and the US will be sort of firmly in the saddle and come out as with China as the winner of the pack. The rest of the world will have to pick where to side politically and how to trade that, and it's going to be a new chapter.
That's interesting.
Starting on from 2019, I guess.
Let's get the rest of the room's view on where we go next on this deal from OPEC last week. How will oil markets react this week coming to the OPEC Plus decision to raise oil supplies by over 2 million barrels from May to July? We saw on Thursday, of course, the markets reacted quite positively ahead of a holiday weekend. But as things get digested and the sort of the numbers get crunched, will there be that same optimism in the markets next week, or will we see? I mean, if we'd asked this question as we did a week or more ago, what would happen if OPEC raised supply? The view was prices would fall, but now the prices are rising. So welcome people's views on where do you think markets will travel next week, and as we digest this,
it's not 2 million barrels a day, it's 700 and a bit thousand barrels a day.
Over the 3 months. Over 3 months.
It's very important also to realize that OPEC Plus has a schedule. Saudi has a unilateral announcement. They can always use that as a safety valve, more or less, the million they have without any kind of consultation. So Was a
Well,
very smart move, I
that's a
would say.
good point. I mean, the point I wanted to ask Mike on that is that you mentioned earlier that this 1 month meeting thing has now, they've thrown a 3 month decision, but yet they're still going to meet every month.
Ramadan, Sean. Maybe Ramadan is a good pretext to. Obviously, they'll convene, and they always convene virtually anyway. So it may well be that if they feel they got it right, they just have a slightly smaller event in a month's time, because of course Ramadan starts in about 10, 12 days time, doesn't it? So the next meeting falls right bang in the middle of that.
Yeah, and they have to stop people like us from speculating and speculating and speculating.
So the idea that they can they make an announcement for 3 months. Why do you think? Where does that go from the point of view? If you have a monthly meeting, ultimately the market has to adapt to the idea that things can change every month. And you keep saying it. It's a monthly number, 700,000. I totaled it up to the 3 month number of over 2 million. But you're looking at it very much month to month, 700, and then we'll see.
Yes, but the point is that the market, I keep saying this, Sean, the market trades well in advance. So
right.
We're into trading the June contract on IFADs, and in many markets, we're already beginning to look at July. So that's just the nature of the market. So May is kind of irrelevant. It's already traded in terms of crude. So that's almost a retroactive imposition if they make any changes. And
we did see recently the UAE adapt its allotment to Asia. They cut the May allocations to Asia ahead of the OPEC decision.
Well, now you saw the Indian announcement in turn. So these are the things under the surface. I wanted to add, I would go even further than Michael, because 700 is the number when you take Saudi and OPEC. I view the Saudi million as a discretionary tool, which they can handle any which way they want without asking anyone. So to me, the number is 350 to 400 per month, which is why we have the market reaction we have, plus a safety valve. That's very smart policy from the part of Saudi Arabia. Can't help but saying that, you know. And I think that's the market.
Why you say they use the word smart? Why is it smart?
Because you have a safety valve without always having this public ruckus of whether Russia agrees to every detail that Saudi Arabia tries to do.
It keeps the unilateral ability to tweak on the market on a month-to-month basis. Mike, coming out of this holiday weekend, looking to next week, what will you be sort of watching? What do you think guides the market?
Whether there's going to be a summer holiday vacation season for the Northern Hemisphere or not. I think it's...
What's the main data point on that? I mean, you would say pretty confidently America will be there. Will anyone else?
I think, yes, indeed. This Easter statistics on the pleasure transport side, booking of short-haul flights is pushing up against pre-Christmas highs. There's another interesting one in the US auto sales. Somebody was quipping that a year ago it was by toilet rolls and now it's by cars. I don't quite know how they made that connection, but those numbers are up. But more seriously now, the ISM or the PMI indices on manufacturing are up well ahead of expectations, both sides of the Atlantic. And that tells you there is a manufacturing rebound humming along somewhere there, despite the pandemic still being a major headache with countries like France, talk in Italy, and of course many other significant parts of the global economy still in lockdown. But yes, travel is going to be vital because there's still up to 3 million barrels a day of jet demand to come back. And that is the lion's share of the remaining demand loss that we're seeing. And I think last month I quipped that if people can't take their children on holiday because children aren't getting vaccinated, then that results in things like you see right here in Singapore, where all the 5-star hotels are full of staycationers and people are filling up the cruises to nowhere that zip up and down the Malacca Straits. I think half my company's on that cruise right now. So, but yes, no, that will be critical. And of course, it's the question.
It's the same here. Every hotel in the UAE is full staycationers. Some foreign visitors, but.
Except, some are from overseas, because of course the UAE is ahead of Singapore in terms of vaccination rollout. Yeah. But we still have entry bans and quarantines that are mandatory. And ironically, the UAE was added to the list of countries which require returning Singapore residents to serve 2 weeks of quarantine, which is why I couldn't go and attend the IFAD launch in person last week.
Which is also happening, strangely, we saw Israel being added to countries in Europe that require 2-week hotel quarantines, even though, and UAE is already on that list, even though those the UAE and Israel have very high numbers of vaccines. Let's get the survey result and give Christoph the last word today. So 54% of the room saying sideways, and then a split between fall and rise. Christoph, your thoughts for the week ahead?
The sideways is what I choose too, whatever that means when nobody knows. But
yeah,
I think next week, so on the adaptations, I agree. When Israel and the UAE, I don't know, that's in the UK, I think that they have them. This will all normalize, and we have seen bureaucratic performance in Europe everywhere, less than stellar. So I'm not surprised that these lists are shifting. Next week, 3 things on my radar. One is the IMF World Bank spring meetings. That should give us a great deal of opportunity to listen to what decision makers actually are thinking about the global economic development. But then for some reason, we have a bunching of inflation data early in the week, including in the US. So that's going to be keenly watched, even though it's too early to expect an update of inflation. That will calm markets a little bit. And then finally, on Wednesday, for those of us really into the short-term market movements, there's a coincidence of the publication of the open market minutes of the Federal Reserve. This is where they discussed their monetary policy a few weeks ago, and the publication of the EIA US crude stocks. And so that combination could be interesting, even though I wouldn't expect big surprises there. This, as a footnote, is something OPEC could still adapt. The way the Fed meetings work is that they publish the minutes with a delay, but they do publish minutes. That's something, a book which OPEC could still do, then it would be even more transparent.
Yes, it'll the more details out of the thinking of OPEC. I think that might offer some insights, a bit like the central bank minutes that we see when they come. Well, this is what we were thinking. Who was behind which decision? Who was against it? That type of granular information might be useful to give some real insights as to this decision. Don't get your hopes up, though. Yeah. Well, rely on the good reporting of some of those that are at the front line of digging out those details. Listen, Christoph and Mike, thank you so much for joining us this Sunday, of course, Easter Sunday, and taking you away from your pot roast or whatever you might do on this special day for those. 6-month notice to the first live event post-summer. The Energy Markets Forum in Fujairah, in person, shake hands, exchange business cards, all the old-fashioned stuff. Being optimistic that will be the case, but we thought we'd flag it with a 6-month notice as we plan for that. But listen, have a great week, everybody. Thank you very much, and we'll catch up to you in the coming days, 10:30 UAE time. All the best. Thank you.
Bye-bye.
Thank you. See you, Sean.